This is a great turnout. Thank you so much, everyone, for coming on I know, a busy Thursday after school holidays. I see a lot of familiar faces, and I should, because I have just ticked over 30 years in the investment management business. So please stay seated. There's no need to stand up. I appreciate the thought of a standing ovation, but thank you. So look, it's been a great 30 years, and I feel very, very privileged to, my timing could not have been better in the early 90s, the superannuation wave. I've just been incredibly lucky to be part of this fantastic business. So, but it's taken its toll. I had hair back in the day. This is me circa 30 years ago. So today I'm going to leave you with my one key investment lesson. I've got a few, but I've only been given time for one, and I think it's the most important one. But before I get into that, if I'm going to put up my picture for 30 years ago, here's the distribution team that Jack just kindly ran through. So we've got Mark Burgess, Jack, man who looks like the Home Alone kid, Marty Van Eyck, whose reputation is probably worse maybe than the old research house, I'm not sure, and of course the lovely Laura. After me, we're going to hear from Emma Fisher, my Deputy Head of Equities. This is sort of her, but inexplicably her parents' house in Turramurra burnt down after she was sent to bed early one time. Emma's going to talk about the Airlie Australian Share Fund, the fund that she is the fund manager for. This is the main event. And look, I think you should have your pens out ready, because look, we like to stick our neck out at these forums. Over the last few years, we have brought our best idea and laid it out. And to be fair to us, we've picked some winners. So 2 odd years ago, I think we listed Premier Investments as our favourite. It was about $20. Today it's 32. It's hit 35 recently. 2 years ago, James Hardie was a big favourite. It was at about $30. And it's hit 65 since then, today about 54. And last year, Emma talked about ResMed as a really key pick. It was really on the skids at the time, and we were loading up heavily in the low 20s, and today that stock is 35. So she'll talk about the fund and the key picks we've got going for this year. After her will be, now this is quite disconcerting. This makes me feel old. So our small cap manager, Will Granger. So he is the portfolio manager for the Airlie Small Companies Fund. We've just launched it 18 odd months ago. And this is where he was when I kicked off in the industry. All right, so my key number one lesson from my 30 years in the market. What is it? And you're probably all rolling your eyes and go, every fund manager says that management matters. And you're thinking to yourself, oh, at least I'm getting a free lunch out of this. Everyone says it. It's a glib kind of statement, and it's obviously true. But I'm here to tell you that it really, really is important. It can make the difference over the longer term between pedestrian returns and absolutely spectacular compounding businesses and returns. And so it's why we spend a lot of time looking at the management teams that we invest in, and it leads us to, more times than not, to those owner-managed, founder-led businesses. And it's really quite simple why. These people have skin in the game, as opposed to corporate managers. So, of course, they've got their short-term incentives, their long-term incentives, but it's different. And now there is some brilliant corporate managers in the market, as we well know. But where we come unstuck, and I think I've spent my whole 30 years, when I look back, in a massive game of tug and war between management on one side, me on the other, and investment banks on the other side. And it's the shareholders, me representing you and your clients, tugging management, and investment banks tugging the other side. It's a massive game of tug of war. And why is that? Because investment banks want to sell large-scale M&A. That's what they do. They want to convince companies to get into large-scale M&A. Now, I see the Magellan executive chairman glaring at me here. We've, come on, mate, we own 36% of Barrenjoey. But I exclude Barrenjoey. They're the good guys. They're a fantastic outfit. They would never try and convince a company to do something they shouldn't do. So we look at the companies and we try and ascertain, are they going to spring on us a poor capital allocation decision that we are not expecting? And we think we've gotten good at it, but we still get stung. And in the last 12 months, we've gotten stung from Aurora, the packaging company. So Aurora was spun out of Amcor about 10 years ago, and we love demergers. So Aurora was a demerger. We love these things because you get a focused management team, they're incentivised right, they've got plans, they're not part of a big conglomerate, they can use their own capital and grow. Long story short, over the 10 years, they've done some fantastic capital allocation. They've sold businesses. They had a few missteps in the US, but small problems. And overall, the stock has compounded over that 10 years, up until last year, at least a 15% per annum return. Management have done a fantastic job, and we knew what we were getting. So Aurora is pretty dull. It makes, in Australia, it produces cans and glass bottles in a duopoly with Visy as their competitor. Fantastic market structure, high barriers to entry, and great returns. So you can imagine our surprise about 12 odd months ago, we wake up to find that they've bet half the company on an acquisition in France, where they're not in, off private equity, for a price that then turned out to be well over the odds. And it was then a painful 6 to 8, 10 months where that great 15% return compound has withered away. The stock halved from nearly $4 and has recovered a little bit since then. So this is where we feel that the management is just so important, and we feel that the corporatised management, we tiptoe so carefully, and we've got to get to know them. We've got to believe in what their strategy is and how good they are at both allocating capital and executing a strategy. So some companies aren't tricky about things. They'll tell you up front what their story is about. So when I began in the market, Foster's, after the heady 80s, had divested itself of all its stuff, and it was a very interesting business, and it was a bit of a flavour for all the fund managers out there, because we could all see the cash flow from selling alcohol to Australians was going to be fantastic. I mean, how could you go wrong? Meanwhile, Wesfarmers, a small farmers cooperative in WA, in the wheat belt of WA, suddenly came into prominence. And when we look at the trajectory of these two companies over the next 10 years, I really believe you can put it down to the two statements that the management ran their business by. Why Foster said that they had to be the biggest, the best, the brightest, the leadingest beverage company in the world, we really don't know. But what it led to was massive, ill-timed, poorly executed and overpriced acquisitions. Wesfarmers, on the other hand, just playing the field as they saw it, looking at opportunities, and ended up making a fantastic acquisition over here on the East Coast, Howard Smith, which really was the genesis of their fantastic Bunnings business. So we really think about the corporatised management. What are they saying? What is their strategy? And it really pays to pay attention to that. Foster's, the share price withered away over time, ultimately got taken over by a global brewer, now owned by Asahi from Japan. And Wesfarmers, of course, is an absolute staple of any private client portfolio in the land. So companies sit across from us a lot and say, Matt, Airlie, how do we get the right kind of shareholders? And what the companies mean by that is, how do we get shareholders who are going to stick with us and not sell? And our response is always, we sort of bring up this slide and say, you will get the shareholders you deserve. And what we mean by that is, the way you allocate capital, the way you execute on your strategy, if you do it right, you will end up with the shareholders you deserve. And Foster's got theirs taken out, and Wesfarmers get theirs, absolute staple of the private client registers. But let's take this to the nth degree of how management matters. So this is my favourite sort of founder-led, owner-managed business. I first started looking at it in the mid-90s. And, you know, what an amazing result for a plumbing wholesales business over the next 25 years. The company has had two CEOs. Alan Wilson, the father, he took over in 1969, where I was not much more, a bit more than an embryo, but still young. And then his son, who's about my age, he took over in the early 2000s, Peter Wilson. So two CEOs. And you can see just what a family, a management team that admittedly, they control 60% of the company, so they can tell everyone else where to go. But what can happen when a plan, a strategy is executed just brilliantly, and the compounding effects of that over time are just remarkable. The interesting fact is, back in 1998, TradeLink was the biggest player in the market in plumbing wholesale, not Reece. Reece were the number two, but coming up fast. TradeLink, corporatised, corporate management. Reece has had two CEOs. TradeLink, at last count, in the last 25 years, on my last count, 5 to 6 management teams. 2 corporate owners in that time. It's passed hands. At the time, in 1998, their sales were about 800 million, so double Reece's. The earnings were probably triple Reece's. Their sales today are still around 800 million. In the last couple of years, they've made losses, leading to the fact, 3 weeks ago, Fletcher Building, their current corporate owner, gave up and sold the business to, funnily enough, a family company out of the US for $175 million. Reece's market cap is $17 billion. So I sort of think, I don't think it's too far a stretch to say that if the management teams had swapped in 1998 and the Wilson family were running TradeLink, I think it would be TradeLink that would be worth $17 billion today. Management matters, I think, also in our own businesses. And one thing we've stolen from Reece is they are very big on values. Every presentation or meeting, Peter Wilson will talk about the values of Reece. And there's a great article in last weekend's AFR where Peter Wilson gives an interview. They don't really give a lot of interviews. But we've stolen this concept for Airlie, and I don't see a lot of other fund managers talk about their values. Corporates used to talk about their values a lot 10, 15 years ago, but a Royal Commission and quite a few corporate scandals have sort of put that to the back burner, I find, these days. But to us, this is very important in how we manage our business and how we focus on what's important. And obviously what's important to us is outperformance. If we're not outperforming, we're not doing our job over the medium term. We've got to outperform over the medium and long term. We know there's a lot of other great fund managers out there. You've got a lot of choice. And the ultimate choice, obviously, is the index. We've got to beat that index. How did we do it? The building blocks of how we run the team. We want to have integrity with how we deal with our clients. We want to do the right thing by them. We have integrity with how we deal with corporates. And we have an integrity with how we deal with ourselves within the team, how we talk to each other, how we operate. If I look back over my 30 years, and I've seen fund managers fall by the wayside, I reckon nearly the number one reason is a lack of, hubris comes in. lack of humility. Hubris, I think, is almost the number one killer of fund management businesses. When you hit a purple patch, you think you've got the game beat. You think that's true. You're sowing the seeds of your own destruction for the future. And look, it's easy for an old guy like me, I think, who's been around for a long time, to think that they understand that I've seen enough cycles. Yeah, I've seen this before. I know what's going on here. I fight against that every day. You've got to have intellectual curiosity. You've got to be willing to learn new things, listening to new views, be challenged by your own sort of entrenched thinking. And, really, the last 20 years, we're going to look back, I think, in 2050, we'll look back at this time and go, this was really was the Industrial Revolution Mark II over the last 20 years. So there's always something interesting happening and to sink our teeth into. So with that in mind, we build a good team. Emma and I think we're very good at developing and fostering a culture, picking a team that works well together, that gives us the best chance to meet our target, our North Star of outperformance over the medium and longer term. Magellan have been a fantastic partner for Airlie. The support they provide, those things on the bottom right-hand side of the page, are world class, and that leads us to be able to just do what we do without having to worry about all those other things that we used to have to worry about when we were a boutique before our merger with Magellan. So, look, thank you. I really appreciate it again, the support you give. We are two of the biggest investors in the fund ourselves. We love what we do. We really enjoy. I know it's 30 years, and I'm still as pumped up and enjoy it as much as I ever have. And part of it is thanks very much to my Deputy Head of Equities, Emma Fisher, who will now take you through the fund. So thank you very much.
Thanks. Sorry. Just get my water ready. Strap yourself in, guys. This is the international sign that I've got a lot of talking to do. Thank you, Matt, and thank you for so thoroughly undermining mine and particularly Will's credibility with this crowd. I just want to set the record straight. That was not a photo of me 30 years ago. I was nowhere near that fire. This is a photo of me 30 years ago. Look, I clearly had a hand in planning it. Not a happy kid. So I wanted to start by saying thank you to anyone here today that invests in our fund. I love the roadshow. I love coming out and meeting our investors and hearing what's on your minds, so thank you for your support. If you're here because you're curious about the fund, I'm hoping today really to lift the lid on how we construct a portfolio and why we pick the stocks that we do. And if you're just here because you shamelessly want the free lunch, I respect that. Pretty sure that's why Marty's here. So thank you for coming along. So Matt kindly shared his number one takeaway from 30 years of investing, an incredible career, 30 years of investing in markets. And if I had to reflect on my own takeaway from not quite as impressive 15 years of investing, it would be that you have to have an investing anchor. You've got to have something that you stand for. Otherwise, you are just going to be buffeted around by the topic of the day, the macro noise, whatever it is that is dominating headlines and markets. And I can guarantee you, if it's dominating the headlines, a big chunk of that is probably in the price. So it's our process at Airlie that we fall back on, that we trust to help. When our process says to buy something, that's when we invest. And taking you through our process, we start with a balance sheet, and this is a yes or no proposition for us. And then we look at business quality, quality of management, and then finally valuation. And frankly, it is quite rare to find a company that looks good across all of these factors. Quite a common scenario is that it looks really good on the first three factors, and then it's very obvious and expensive, and for us it falls over on the fourth factor. So businesses like that, the best thing we've got in our arsenal is patience. We put them on a watch list, we stay close to the story, and then maybe every now and then we get our chance to invest. And I've got a couple of examples of that later in the presentation. And the difficulty, I suppose, of finding ideas that do pass, that look good across all of these 4 factors. The difficulty of that is why we really believe in concentration. When you find something that looks good across all of these 4 factors, you really want to have a meaningful position in your fund. And now meaningful for us is typically 2, 3, 4, as big as 5% active. We don't like to go much bigger than that because we could always be wrong, and we don't want to be completely skewered by one wrong investment. So we typically max out at about 5% active. But it is a concentrated fund. It's typically around 30 ideas because there aren't that many more ideas that pass our process. Turning to performance, this fund has been running for 6.5 years, and I think Jack introduced us by saying we consistently outperform. Every year when we had the roadshow, I've been really proud to put this slide up. I do want to talk about this one year that we've had. I don't normally like to focus too much on a 1-year number, unless of course it's good, in which case, bank it forever. But I think it's worth sort of delving in what's gone on here, because there's been one very, very large headwind for us, and that effectively we've gotten wrong, and that has been our positioning in the big 4 banks. You can see we underperformed this year by 2.6% net of fees. If we added up what the big 4 banks has cost us this year, it's been 4.4 percentage points. So, you always feel a bit silly saying, if not for those pesky things that caused us to underperform, we wouldn't have underperformed. But we would have just had our normal year. We've been underweight banks since inception. We've always been able to offset it. If they have a good year, we've offset it with other things that we've owned that we find more attractive. This year, it's nearly a quarter of the market. The share prices are up 40 to 50%. It's just been too big a wall for us to climb this year. So I just want to flag that as one thing that we've gotten wrong this year. I wanted to, just on performance, really drill down on where the performance has come from and what I guess it's sort of saying about the nature of the way that we structure our fund. So if you've invested over the last 5 years in the ASX 200, you've had a return of just over 50%. For our fund, it's more like 76.5. So I wanted to focus on that cumulative positive return of 28.65 and break it down into our best ideas over the last 5 years. So a couple of takeaways. The first one, even inclusive of this 1% headwind this year, MinRes has been far and away the best idea. And I think the first 2 ideas there, MinRes and PWR Holdings, are great examples of when the stars align under your process. Both of these businesses at one point in time, it was green lights across the board. We had a 5% active position, and we did very well out of both of them. Now, we have sold a lot of both of those ideas over the years to effectively, I guess, lock in that performance because, again, if you take something like PWR, everything still looks the same in terms of the quality of the business, the management team, founder-led business, net cash balance sheet, but the valuation, when we found it, it was on 24 times earnings, $4.50 share price. It tripled, towards $13 over the years, and that re-rate with a PE now in the mid to high 30s. That's where we took a lot of the weight out of the position. And then another takeaway, I guess, from this slide is, the first 5 names there, and the 6, if you include 7 Group, are all owner-managed businesses. So as Matt alluded to, we're big fans of investing alongside founders, and in fact, many of those have been our best ideas over the years. And then finally, I guess the other takeaway is a lot of these businesses started off or are still in the small caps index. So the small caps is just anything outside the 100. So we've had a lot of success there, and our lens is always trying to find great companies to put in the portfolio that we think can, double or triple or more. We wouldn't buy a small cap if we thought there was like 30% upside, because as you know, with small caps, if the liquidity's not there, you can't always trade out of it. Whereas when you're looking at large caps, 30% upside, ship it in. So for small caps, our hurdle is higher. We've only ever owned a few small caps in the fund, but we've had very good success with them over the years, and I guess that sort of underpinned our confidence in launching a small cap product that you'll hear a lot more about from Will later. So bringing it back to the process, and I just want to sort of drill into each of these parts of the process to explain what we look at. So the first one is financial strength, and we wanted to backtest this. So we got Macquarie data to take the market, the ASX 200, and separate it into quintiles. And the metric that we chose to measure financial strength is EBIT interest cover, which is basically how many times over does the operating income of your business cover your interest expense. So it's a measure of your financial strength. And we were expecting that green line, which is the bottom quintile, we were expecting that to underperform because, think about it, these are the businesses that are most likely to have to raise. they've got the worst balance sheets. But we were surprised by the degree of outperformance of that top quintile. It really validated our own suspicion and how we'd felt over the years about investing, which was the market's not very good at putting a value on the latent optionality that a good balance sheet gives you, but it certainly does give you a lot of optionality. And in fact, the bulk of the fund is invested in businesses that are either in quintile 1 or quintile 2 for financial strength. In terms of business quality, that's the second part of our process, probably where we spend the bulk of our time. I always feel like when I talk about quality, people might feel as though, oh, well, that sounds pretty subjective. But we're quite lucky because we have a metric that takes the subjectivity out of things, which is the return on capital that a business generates. So we look at the historic return on capital that a business generates as a big clue to the quality of the business. Because competition theory is basically, if you pick a business where there's no barriers to entry, like if Matt opened a hair salon, or probably a bad example for you, Matt. Matt opens a hair salon, he's got his customers, I can see he's making super profits, there's no barriers to entry there, I'm going to open up next door. People are going to go, I'm going to that girl because she probably looks like she knows a bit more about hair. And his returns are going to be bid down to a normal level. So when you see a company have a high sustained return for a very long period of time, that's your clue that there is some competitive advantage going on in that business. And often that's where we'll sort of roll up our sleeves, do the work to try and understand what that competitive advantage is. Now, of course, it's not just as easy as buying all the businesses that have high historic returns. The art of funds management, I suppose, and the art of investing is your ability to predict the likelihood of future returns staying high, or even future returns improving. That's where the alpha is. Often the businesses with the best returns historically are the most expensive, and they're sort of not that attracted to us under our process. So a lot of this is sort of a mix of weighing and respecting the history of a company, but also predicting what might change in the future. Now, again, we back-tested this, so Macquarie Data did the same, and you can see that quintile 1 for 5-year average return on invested capital dramatically outperformed the index. And again, the bulk of our fund is invested in businesses that fall into quintile 1 or 2 on 5-year average return on invested capital. Another way to kind of look at it is, I like to have a yardstick in my mind of what average is in the market. So right now, the average industrial business, and I pick industrials because you take out banks and miners, they kind of move things around, but industrial business trading on 21 times earnings, and it generates a return on invested capital of about 11% over the last 5 years. So when you think about quality on the ASX, your mind probably goes to businesses like these green dots. So your Cochlears, your REAs, your Seeks. These are very high quality businesses. And you can see that because they generate 2, 3, 4, 5 times the returns of the market. The challenge is if the quality is obvious, everyone can see it, and the market rewards them with a very high valuation. Now that's fine. We would love to own any of these businesses at the right price, but for us, that's sort of outside our comfort zone. What we're looking for is businesses that can are just as good, generate the same level of returns, but aren't on those same high multiples, that fit our definition of undervalued quality. So these pink dots are businesses that we own in the fund, and as you can see, they generate similarly 2, 3, 4, 5, Nick Scali's out there as an outlier, nearly 6 times the return on invested capital of the market. And I mean, Nick Scali's cheaper than the market. Now, there's a different reason for why every single one of these businesses is on a lower multiple. It's not that we think they all deserve 50 times earnings. A retailer like Nick Scali or Premier Investments, they're never going to, nor should they trade on a very high multiple because there's a lot of operating leverage for a retailer. Everyone's always worried about the cycle. But the fact that they generate high returns and they're cheap means that they don't need capital to grow. They open up their stores, they're just leasing them so that, it's a very capital light rollout, and they pay out all that cash back to you as shareholders. So Nick Scali's been a phenomenal investment over the years. It's been a core portfolio holding, and a huge chunk of that return has come through dividends because they don't need the cash that they generate. They don't need to retain it to grow the business. We get pre-submitted questions for the roadshow, and I like to read through them, see if I can kind of answer some of them in my presentation. We had quite a lot of questions that were some derivative of, are you guys truly bottom-up investors, or how do you think about the macro? And the answer to that is, sort of both. We are true bottom-up investors. We do think about the macro. We read about it. We think it's interesting. What we don't do is, think, okay, well, China's going to do this, so we need that exposure. You know, we're not making macro predictions and trading on them. We love the macro because it's probably the thing that throws off the most common bucket of undervalued quality stocks, which is when everyone gets really, really worried about a cycle, the whole sector exposed to that cycle gets very, very cheap, and you can buy the best business in that cycle for very, very cheap. Now, as Matt alluded to a couple of years ago, North American housing cycle, Fed was raising rates, all these stocks got absolutely hammered. You could buy James Hardie, which had very little debt, incredible return on invested capital through the cycle. You could buy it on 13 times earnings. You know, and the business has now, you know, at one point doubled off that bottom because everyone was worried about the US housing cycle. Last year, everyone was worried about Australia going into recession. You know, you could buy a lot of the retailers for very, very cheap. Nick Scali doubled, Premier Investments doubled, because again, this Armageddon that everyone was so worried about didn't come to pass. I guess through that lens, where we're seeing sort of undervalued quality opportunities, or certainly up until September, was more in the resources space. You know, we are no experts on China. I don't believe anybody knows what's on Xi's mind or what his next steps are. But ultimately, you look at the share prices and where that intense fear around the macro is pricing in really, really bearish outcomes. And so we can add to a business like BHP at $38, knowing that the opportunity is everyone's worried about where the iron ore price is going. If it goes to 80, if it goes to 70, which would be incredibly unlikely given where all the rest of the assets sit on the cost curve, BHP's costs are $20 a tonne. So it doesn't, actually they're below that. It does not matter if for a very brief period in time, if you think about a discounted cash flow model, how you truly value the future cash flows of a business, 1 year doesn't actually change your value very much. It changes, you know, maybe by 2 or 3%. But it will change the share price by like 50% in some instances because, you know, iron ore in this instance sells off and everyone gets really worried. This business has like very little debt, incredible assets, and so you can add to it without much fear and just take advantage of this. Another one that we added a small position in the portfolio was IGO. They own a quarter of Greenbushes, which is Australia's, well, it's the world's lowest cost hard rock lithium asset. So again, rain, hail or shine, even though lithium is in like the hurt locker and it's well into the cost curve, they are making money at that asset and it doesn't have any debt. So that was where we were seeing opportunity most recently through this lens of undervalued quality. Management quality, you know, Matt spent a lot of time on this, so I won't spend too long, but I would say we back tested our owner-managed index. So these are all the owner-managed businesses on the ASX. If you just invested in them, you've had a much better time than owning the ASX 300. And then finally, valuation. So this slide takes you back to the last boring year of all of our lives, the year 2019. I picked 2019 because I don't know about you, but I can't remember one thing that happened in 2019, certainly not in markets. I think in retrospect, we can all say it was a very boring year. I'm sure at the time, it felt very dramatic. And you can see that there must have been some drama because the 52-week high and low on average of the top 20 boringest blue chip stocks in the ASX changed by 54% that year. So in this boring year where we can all agree nothing happened, 54% change in the highs and lows. Now, if I do this analysis for any year subsequently, that number gets bigger. Now, that is why we love our jobs. That's why we believe in active management. We exist, I suppose, to kind of exploit the tension between the very, very slow pace of change in the real world, businesses are changing over years and decades, and the very, very fast pace of change in the share market. So we are always using valuation as the tool that effectively throws off the most opportunity. And things can go the other way. So I mentioned before that banks have really hurt us this year. The reason why I'm comfortable with the underweight that we hold in banks from here is because if we break down the year that they've had into 3 buckets, any stock total shareholder return is driven by 3 things. It's driven by earnings, driven by dividends, and it's driven by the PE multiple that you're paying for that business. Now you can see that over the last year, the total shareholder return of the Big 4 has been 40 to 50%, and the vast majority of that has come from PE re-rating. It hasn't come from earnings. It has, you know, a sliver, 3 to 5%, depending on the stock, has come from dividends, but the bulk of it has come from the multiple. Now, in our minds, that is a one-off driver that can just as easily and arguably should go the other way. If you pick on a bank we don't own, so we own CBA and NAB, but we've been reducing our holdings in both, and we do not own Westpac or ANZ. Now, picking on Westpac, for example, If we go back to the year 2011, Westpac did an ROE, so a return on equity, of 19%, and you paid 10 times earnings for it. Today, ROE has collapsed. It's doing an ROE of 9%, so it's more than halved, and you're paying 17 times for it today. So in our minds, this isn't justified. You know, my favorite quote in life is a quote from Martin Luther King. Now, I acknowledge he was probably using it for more lofty ideals than whinging about Aussie bank valuations. But the quote is, the moral arc of the universe is long, but it bends towards justice. And I've always loved that quote when you apply it to investing as well. You know, the moral arc of the investing universe is long, but it bends towards justice. I have seen so many unsustainable things happen in my career. Blips, buy now, pay later frenzy, tech wreck, now a bank bubble. If something's unsustainable, it won't be sustained. So I'm hoping, you know, if we apply that concept of justice, what does it mean in an investing sense? It's this notion that there has to be a relationship between the quality of a business and the returns that it generates and the valuation, you know, what you're paying for that business. Now, we have always seen that with banks, and for some reason lately, you've had this enormous breakdown in that relationship. We would just prefer to allocate that capital towards businesses that we think have a more attractive return between the returns of the business and the valuations. So I want to give you some examples of those. So the first one is ResMed, which might be a bit of a denouement, a little bit boring considering we talked about this stock last year and it has had such a phenomenal run. But the reason that I wanted to talk about it again this year is because simply it is still our largest position. Now, I said 5% is about as high as we go in a stock, and this time last year we were 5% active in ResMed. Today we have sold some and we're about 4% active. But it's still, in our minds, an outstanding investment, even at today's share price of $35. So for those of you who are unaware, so ResMed basically virtually now a monopoly. They do have one competitor who has about 15% market share, but they have about 85% of the market for sleep apnea devices. So you use a CPAP device and you have a mask. So it's this beautiful sort of razor blade model where you sell the device and then you sell a couple of masks each year, and it is used to treat patients with sleep apnea. Now, if we put it through our process, looking at the balance sheet, it is actually this half it's going to be in a net cash position. So it's firmly in quintile 1 for financial strength. On business quality, the return on invested capital has averaged 27% over the last 5 years. So it is, again, over the last 25 years, again, firmly in quintile 1 for return on invested capital, for business quality. Looking at it through another lens, you know, there aren't many businesses with a chart like this. Sales and EBIT have compounded at 17% per annum since 1999. It's been a phenomenal success story. On the management quality side, again, ResMed is an owner-managed business. The founder, Peter Farrell, his son, Mick Farrell, now runs the business and is the executive chairman. I mean, when this was announced a few years ago, you know, we had our qualms, like, looked like a bit of a Nepo baby situation, and it was quite a funny release, actually, you know, that the dad put out saying, we've done a worldwide global executive search. Oh, it's my son. But to be fair, he's done a really good job. He's done a very good job at ResMed. And actually, there's a bit of a theme here. Reece, second son. ResMed, second son. Seven Group, which has been another phenomenal performer. I would argue that Ryan Stokes has done a better job running that business. I think it's up 5 or 6-fold since he took over. So maybe there's some fund out there that can do an ETF trading on the second son, and probably dumping it by the time the third son comes around, or daughter. And then finally on valuation. So ResMed was a classic example of patience for us. You know, for so many years we admired its quality, but it was a green dot for us. It was up, you know, the PE was up in the 40s at one point. It derated. I won't spend any airtime on the GLP-1 debate this year, but suffice to say it derated a lot because everyone had decided that obesity was cured because of Ozempic and those drugs. At one point, it was, you could buy this business that has that phenomenal track record. You could buy it on the same multiple as the market. You could buy it on 21 times earnings. Now, what's been interesting is it has had this phenomenal year in terms of performance, but a lot of that's actually just come through earnings growth. It has re-rated from 21 to 26 times, but in our minds, considering the rest of the business and the quality of everything else, 26 times, you know, a little bit more than the market multiple for a business of that quality is still a very attractive proposition. So when we put it through our process, we are getting those green lights across the board, and accordingly, we've still maintained a very large position in it. Talking through one more idea, Medibank Private. So Medibank is Australia's largest private health insurer. So again, when we put it through our process, financial strength, it's net cash. So it's firmly in quintile 1. It has generated a return on invested capital over 30% for the last 5 years. So again, firmly in quintile 1. And I think that's, oh, sorry, I know I'll come to this point in a second. So I think this is interesting. So it's trading on 16 times earnings here. Now, if you think about Westpac for a second, that business does an ROE of 9%, and it only gets there by gearing the bejesus out of that business to generate an ROE of 9%. So you always kind of have to know, everyone forgets how cyclical banks are until they see a cycle, but that is a highly geared business delivering a 9% ROE. Medibank has no gearing and generates a return on invested capital of about 30%. So this is a much higher, much more profitable business. Now, and it's trading on a cheaper multiple than Westpac. And I guess that's what I meant by saying we'd much prefer to allocate to a business like this rather than a business like Westpac. Now, good businesses that look so good on those first 3 factors don't just trade on below market multiples for no reason. There is always a fly in the ointment for every business. Our job, I guess, is to get comfortable with that fly in the ointment and figure out whether or not that's something that we truly need to be worried about or something that's really just creating the opportunity. Now, the fly in the ointment for Medibank is regulatory risk. You know, I'm sure if any of you have been reading the papers lately, you see this debate, this stoush that's occurring between the private hospitals and the health insurers. Now, what's happened is, post-COVID, surgery volumes have been very slow to pick back up. Private hospitals have faced a lot of inflation in their cost base, and they're basically arguing that the insurers aren't sharing enough of the pie with them, and they're calling to the government via the media to intervene and kind of come down on them with a big stick and force them to redistribute the profits. The health insurers say that you know, they have been funding the industry, and I think there's a lot of truth to this, the private hospitals have built the wrong product. They have built beds. The structural problem for the industry is surgery techniques are changing, and basically they're shortening length of stay. 5 years ago, 65% of surgeries in the private setting were a day surgery. Today, that number is 70%. We don't know how high it's going. Most of the things that get treated in a private hospital, like your knees and hips, things like smaller surgeries, a lot of those can be treated in a day hospital. And this is a situation where it's win, 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 lose. It's win for the patient, because who on earth wants to stay in a hospital? Food's terrible. You just want to go home. It's win for the health insurers, because the bulk of the cost is in the night stay in hospital. It's not in the surgery, so they save money. It's a win for the government, because the same trends are playing out in the public system, so anything that saves the private system money saves the government money. It's a lose for hospitals, because they've built beds, and now some of the beds are empty. So they're whinging. Some of them are private equity owned, offshore private equity owned, and they're whinging and asking for government intervention. Now, what does it mean if they were to intervene and to share the profits more with the hospital sector? It means one thing. It means your premiums are going up. And the government is so sensitive to that, especially heading into an election year. They do not want private health insurance premiums going up a lot, because the health insurers will say, well, we have to because you guys have done this. So I think that this is, there may be some tweaks. I think this is an ongoing feature of the industry. The entire time Medibank has been listed, it came out of government hands in 2015, the entire time they have faced regulatory risk. Bill Shorten had a 2% cap on premiums. They've navigated that. They've had a cyber event. They've navigated that. We were buying it hand over fist. The share price fell to $2.70. They've navigated COVID, and now they're navigating this. So ultimately, we think that this is a great business, very well managed, and now you can buy it at a very cheap multiple because of this regulatory risk, which is just a part of the nature of their business. So when we put it through our process, again, it looks very attractive. So it is a top 5 position for us. So this is sort of the final slide for me, and it's probably the one that I'm most proud of, because when we put our fund through, fund as a whole through our process and sort of test the characteristics, you can see that on financial strength, the average net debt to EBITDA of the fund is a lot lower than the index. The business quality, the return on invested capital is 26%, which is double the return on invested capital of the index. The percent of the fund that's in owner-managed businesses is 30%, which is triple the 10% of the index. And then finally, the position-weighted PE ratio is 22 times, which is in line with the index. So often with Airlie, I think probably given Matt's tenure, there's a tendency to want to put us in the bucket of value investors. But I just want to be really clear that this is not about buying cheap businesses. As this sort of spits out, we don't target this, but as this data sort of spits out, we own businesses that are actually valued in line with the market, but we think give you access to a much higher range of qualities, and indeed the 4 qualities that we think drive long-term wealth creation when you're investing in Aussie equities. So that's my last slide, our top 10 active positions. Please grill us on any of these. We love talking stocks. And I'd like to hand over to Will. Thank you.
Thank you, Emma, and thank you everyone for giving me some time today. My name is Will Granger and I'm the Portfolio Manager of the Airlie Small Companies Fund, which we launched in April last year. So I'm really excited to talk about the fund today. We're going to spend a bit of time talking about how we think about the small cap market. We'll explain how we apply our process to small caps, and then we've got a couple of stock ideas that we're really excited about that we'll take a deeper dive into. But before we get into that, I think the best place for us to start is, why did we want to launch a small cap fund in the first place? As I mentioned, we launched the fund around 18 months ago, but really the genesis of the fund well predates that. It's something we'd been mulling over for a while at Airlie, and that's because small cap investing isn't new to us. The team has spent several years successfully investing in small caps as part of our other funds and mandates, and some of those ideas have been some of our best performers. So Emma touched on a few of these names earlier. Businesses like Nick Scali, Premier Investments, Mineral Resources, News Corp, PWR Holdings, Seven Group. All of these names, when we first purchased them, were small caps. And again, they've gone on to be some of our best performers. So we really have a track record of identifying great small caps, and we think we can continue that into the future. As for me, I really cut my teeth investing in the small cap market. So prior to Airlie, I ran a long short portfolio that was largely invested in small companies. It's a part of the market I'm very passionate about, and so I'm very grateful to Matt and Emma for the opportunity. So that's why we launched the fund. But how does the fund actually invest? Well, this slide should look very familiar. It's the exact same investment process that we use across all of our funds and mandates. Now, the only difference here being that our universe is different. So we're investing outside of the ASX 100. Now, the fund currently holds 25 stocks, but it should be noted that it's very concentrated at the top end. So the top 15 ideas in the fund account for more than 75% of the portfolio. So investors should understand this is a very concentrated bet on some really high quality small cap opportunities. This slide should also look familiar. The fund is leveraging the exact same Airlie investment team. As I mentioned, our universe is outside of the ASX 100, so analysts are probably spending a quarter to half of their time looking at small caps. So there's a huge body of work on small caps that the fund is leveraging. In fact, 40% of the fund today is invested in names already owned in other Airlie funds and mandates. On to performance. We're really pleased with the start we've had for the fund, but obviously it is still early days, so I'd caution investors reading too much into short-term numbers. What I think you can take a little bit of comfort in is the fact that I'm invested alongside you. So when we launched the fund, I sold all of my direct equities exposure and put all of that capital into the fund. It represents the majority of my net worth, and I'm invested on exactly the same terms as every other investor. So we've got a couple of stock stories that we're really excited about, but before we do that, I think it's worth explaining how we actually think about the small cap market. And I'm going to start by doing something perhaps a little bit unusual for a small cap pitch. I'm going to start by explaining why we think the small cap index, the Small Ordinaries Index, is actually a terrible index that investors should avoid. And it's for a simple reason, really. If you look at the performance of the Small Ordinaries Index over time, it's consistently underperformed the large cap index, the ASX 100, over most time periods. So here we've collated the last 20 years for you into 4 or 5 year periods, and we've measured the total return of both indexes. And as you can see, 3 out of 4 times the index, the small cap index, has underperformed. And that underperformance really has been quite material. In fact, had you bought the Small Ordinaries Index when it was first created back in March 2000, over the next 24 years, you would have enjoyed just half the return of the ASX 100. So the numbers really bear this out. It hasn't been a good place to put your money. What's interesting about that, though, is despite that terrible index performance, small caps is actually home to the top performing stocks in the market. How did we measure this? Well, we combined the ASX 100 and the Small Ords Index, and we looked at every year and we said, what were the top 10 performing stocks as measured by their total return over the next 5 years? And as you can see, on average, 8 out of 10 of those stocks actually came from the small cap index. So 80% of top performers. It's really quite an astounding figure when you consider how materially the index has underperformed over time. Even in its worst years, 6 out of 10 of the top performing stocks were actually found in small caps. And I think there's a few conclusions to draw here. One, if you want exposure to the top performing stocks in the market, you need exposure to small caps. Two, you can't really get that exposure through the index because it's been a poor performer. So you really want an active manager who can sift through the weeds and identify those high quality opportunities. I think the other interesting conclusion to draw is, given that the index performance is poor, yet it's also home to the top performers, there must be some really poor performing stocks that are dragging down that performance. So what's actually wrong with the index? Well, if you take a closer look at the constituents, you'll notice there's a lot of junk in the index. In fact, out of the 179 constituents, 1 in 3 have produced negative free cash flow over the last 3 years. 2 out of 3 companies generate a return on equity less than 12%. And 1 in 3 companies are in the mining and energy space, many of which are located at undesirable parts of the cost curve and thus generate poor returns through the cycle. So really there's a lot of junk in the index, and that's what's been weighing down the performance. Luckily for Airlie, our investment process, which really focuses on prudent, common sense investing, means we avoid a lot of this junk. We think just by avoiding the junk, you can comfortably outperform the index, but we also backtested the data. So here you have the performance of the Small Ords Index since its inception. Now at Airlie, we don't buy concept stocks with no earnings. We like to focus on real businesses that we can understand and value. We think a good proxy for whether a business is a real business is, does it produce positive cash flow? And so we went and backtested the data. And we said, what would happen if I just bought the cash flow profitable businesses in the index? How would I perform? Well, as you can see, you'd comfortably outperform the index over time just by getting rid of that, those cash flow loss makers, getting rid of that junk in the index. Now, we also have a strong focus on financial strength. Here we split the index into quintiles, so 5 equal parts, using interest coverage ratio as a proxy for financial strength. And we said, what would happen if I just bought the top 20% of businesses as measured for financial strength? How would I perform versus the index? And once again, you'd comfortably outperform. So just by making these two simple exclusions, by focusing on financially strong businesses and avoiding the junk in the index, you can outperform. And what's interesting is this brings your performance about in line with the ASX 100. So it really goes to show it's that junk that is dragging down performance. Now at Airlie, we've also got a strong focus on quality, as Matt and Emma have talked to. Here we're really talking about businesses with durable competitive advantages that can fend off competition and grow at attractive rates on incremental capital. Really the hero metric here, as Emma talked about, is return on invested capital. So we used 5-year average ROICs as a proxy for quality. Again, we split the index into quintiles and we said, what would happen if I just bought the top 20% of businesses? As you can see, not only would you comfortably outperform the Small Ords Index, but you'd also comfortably outperform the ASX 100 as well. So hidden within this otherwise quite miserable performing index, you've actually got some really high quality opportunities in the market. And we think we can do even better than that by going and applying our process and really picking the eyes out of this quality subset. So that's been a lot of sort of high-level data and theory. Let's look at the process in action. We've got a couple of stock stories we're really excited about today. The first stock I'll be talking about is a business that's positioned at really the coalface of the largest global transformation project, and that is the energy transition. And the stock I'm talking about is Gentrack. So for those who don't know, Gentrack is a provider of utilities enterprise software. So this is basically the software that runs the entire business. It does everything from customer information and billing to energy and data management. And the opportunity for Gentrack is the energy transition is creating a lot of change. So the old grid, the grid of yesterday, was one characterised by centralised generation and one-way distribution. So you'd have coal or hydro assets generating energy that would be pumped through distribution channels to businesses and homes. It was a very linear and simple process. You'd have dumb meters taking reads every quarter or every month. But the needs of the energy transition means the grid is increasing in complexity. The grid of tomorrow is one characterised by decentralised generation and two-way distribution. So you now have assets in people's homes like EVs, solar panels, batteries that can buy and sell off the grid. You have smart meters taking reads every 5 minutes, and you have dynamic pricing. Now, all of that reflects a massive increase in the complexity of the grid, which means that the software that these utilities have been operating on, some of which is 20 or 25 years old, is no longer fit for purpose and needs to be upgraded. So there's a huge structural growth story behind this stock. What does the competitive landscape look like today? So competitors really fall into two buckets. You have the incumbents, SAP and Oracle. They've got around 75% market share. And then you have the specialist providers like Gentrack, Kraken, and Kaluza with around 25% market share. Now, what's interesting is some economies, some grids are further ahead in terms of the energy transition than others. They're more decentralised in terms of their grid. And really, if you look at Gentrack's core markets of Australia, the UK, and New Zealand, they're probably the most advanced markets in the world in terms of decentralising their grid. And what's interesting is if we look at the market share in those markets, SAP and Oracle have fallen to less than 10% market share. Now, we think this is a really good proxy for what the rest of the world will look like as markets continue to decentralise their grids. It's a massive market, so there's a massive opportunity for Gentrack. The market's estimated at $17 billion, so even just a 10% market share for Gentrack would be a massive step change in the size of the business. So that's the opportunity set for Gentrack, but how does it fit through the Airlie investment process? In terms of financial strength, it gets a big green tick. It's got a very strong net cash balance sheet, really strong free cash flow generation. So big tick in terms of financial strength. In terms of business quality, we really like businesses that sell this type of mission-critical enterprise software because typically it comes with very low customer churn, given how costly and disruptive it can be to switch providers. So these are massive projects for the utilities. It can cost anywhere from $50 to $250 million to upgrade your software. It can take 12 to 24 months to implement. It's the kind of thing a utility wants to do maybe once every 10 years. So that's great for the software providers because it means once you win a customer, they're effectively locked in for a decade. That creates a lot of durability with the business. Gentrack itself is a testament to this. It's been around for more than 35 years, which is pretty unique for a small tech company. If you look at the chart on the right, you can see Gentrack sources its revenue from a very diverse range of customers. So they serve over 65 customers across 17 regulated markets in 7 different countries. So we think it's a really high quality, annuity-style, predictable revenue stream. In terms of return on invested capital, as with most tech companies, there's very little tangible capital in the business, so it generates a very high ROIC as well. In terms of management quality, so the business is run by Gary Miles, who joined in 2020. And whilst his tenure has been short, Gary does have a terrific track record in enterprise software. So he's founded and then subsequently sold 2 enterprise software businesses, the latter of which he sold to a business called Amdocs, which is the market leader in telco enterprise software. So that's a NASDAQ-listed business. It's around a $9 billion market cap. It's got around 25% market share in telco enterprise software. You can see in the chart on the right there, it's a pretty impressive track record. And Gary held some very senior roles at Amdocs before joining Gentrack. So he understands the enterprise software space extremely well, and he's very entrepreneurial, which we like. He's also assembled a very impressive team beneath him. So Gentrack's COO used to run all of delivery for Amdocs. Gary poached him across the business. The CTO used to be the CTO of Xero for several years. So that's a really impressive team that is assembled to, again, a pretty small tech company. So we think that speaks volumes to his management abilities. The board have also set a very attractive REM structure, an LTI that aligns Gary well with shareholders, which we like. So big green tick in terms of management quality. Finally, in terms of valuation, Gentrack has had a fantastic run. I think we first started buying it around $3 and it's closer to $10 today. But importantly, we think there is still some good valuation upside there. Now, the business trades on around 30 times EBITDA, but that EBITDA has struck off quite depressed margins versus history. In fact, if you adjust EBITDA margins back to the around 30% historical levels, the business is trading on around 18 times EBITDA. Now, we don't think margins are going to get back there tomorrow, but it's a good illustration of the operating leverage that may be ahead of the business. And we think that's a really attractive entry price for a business with such a fantastic opportunity set ahead of it, as well as relative to other high quality software peers. We only give Gentrack really sort of a light green tick in terms of valuation because there is still a lot of execution risk in terms of getting those margins back to historical levels. So through the Airlie process, really it gets close to full marks, which is why Gentrack is a core holding in the fund, and it's one we're still really excited about. Now, for the second stock story today, look, when we're shareholders in a business, about the worst announcement that you can wake up to is equity raise to fund acquisition and entry into new international market. That strikes a lot of fear in our hearts, and it's for good reason. And Matt talked to a few of these examples earlier today, but plenty of Australian companies have really been humbled by their global ambitions. So a few that come to mind: Boral with its acquisition of Headwaters in the US, Bunnings foray into the UK with Homebase, or more recently Aurora and its entry into the European market with Saverglass. Clearly, lots of Australian companies really haven't done well with overseas acquisitions, and earlier in the year, our fears were realised when one of our core holdings, furniture retailer Nick Scali, announced its entry into the UK market with the acquisition of Fab Furniture. Now, famous last words, but this time we think it's different. And that's for a few key reasons. I think most importantly, this is not a Bet the Farm acquisition. So the total cost of the venture, including rebranding and refurbishing the 21 store network, is estimated at just $50 million, or around 5% of the Nick Scali market cap at the time of acquisition. So clearly there's limited downside here, and you compare that to Boral's acquisition of Headwaters, 58% dilution, Aurora's acquisition of Saverglass, 45% dilution. Clearly this is a very different type of bet. Furthermore, management have a track record of creating value through acquisition. So back in 2021, Nick Scali acquired Plush Furniture on just 4 times EBITDA. They then vastly improved the quality of that business by leveraging the Nick Scali supply chain to improve gross margins by 8 whole percentage points. That's a massive improvement in the quality and profitability of that business. And really the playbook for Fab Furniture is largely the same. It's rebrand and refurbish, or different for Plush, but rebrand and refurbish the store network, and then leverage the Nick Scali supply chain to improve gross margin. So management have done it before, and we think there's a good chance they can do it again. The balance sheet is also in great shape, so the deal was equity funded. I'll touch on that in a little more detail in a moment. And finally, there's material upside if the venture proves successful. So the UK furniture market, it's roughly twice the size of the Australian furniture market. So there is scope to build a business that could one day dwarf the size of the core ANZ business. So we really think this is an asymmetric bet by management, very limited downside and potentially massive upside if the venture proves successful. So that's the opportunity for Nick Scali. How does it fit through Airlie's investment process? It's got a fortress balance sheet, significant property holdings worth $120 million at book. There's $40 million of net cash there, very strong free cash flow generation, so plenty of capacity to expand in the UK, plenty of funding. In terms of business quality, Nick Scali has really got one of the best track records on the ASX. In fact, it's one of just 11 companies on the ASX to have generated a return on invested capital after tax of greater than 15% in every year for the last decade. So quantitatively, it's one of the best businesses on the ASX. It's got a fantastic track record of growing EBIT, as you can see in the chart on the right there, 14% CAGR for 20 years. So very impressive big green tick in terms of business quality. In terms of management quality, you've got one of Australia's best retailers at the helm in Anthony Scully. He still owns 8% of the business, and he's got a great track record of creating value for shareholders. So had you bought Nick Scully at IPO and reinvested all of your dividends, you would have made more than 30 times your money. That's more than 10 times the return of the index over that period. So really impressive track record of creating value. And I think in retail, more so than most industries, really the importance of good management is paramount. And there's few managers I'd back more to execute on the UK expansion than Anthony Scully. In terms of valuation, the business trades at around 16 times PE, so about in line with historical averages, but a steep discount to the market. And importantly, this ascribes no value to the UK expansion, which again is fully funded. So you're effectively getting a free option on a business that could one day transform the size of, or dwarf the size of the core Australian business. So we think it's a really attractive valuation as well. And so really it's green lights across the board. It's full marks for Nick Scully, which is why it's a core holding, not just in the Small Companies Fund, but across many of our funds and mandates at Airlie. Now that's about it from me today, but there's just a few thoughts that I'd like to leave you with. So as we discussed at the outset, the small cap index, it really is full of junk. It's been a terrible performer over time, but paradoxically, it's also home to the top performing stocks. So you do want exposure to small caps. That means you needed an active manager who can sift through the weeds and identify the high quality opportunities. Perhaps for some of you, that might be where Airlie steps in. We do have a demonstrated track record in small caps. We've been investing in the small cap market for several years. And again, they've been some of our best performers. And we think the fund is really well positioned today to continue that legacy into the future. So thank you very much for your time today.